Being afraid of the stock market is one of the most rational things a person can feel. That is not sarcasm. That is not a setup. Exposed to volatile price swings, you cannot control. Risking money you cannot afford to lose. Watching a number drop 20% in a week with no clear reason and no clear end. The fear response to that is not a bug in your psychology. It is the psychology working exactly as designed. And yet, exposed to a different kind of loss, one that compounds daily, one that takes more from your household over 10 years than most market crashes ever will. The fear response is almost non-existent. 46% of credit card holders carried a balance at least once in the past 12 months. According to the Federal Reserve's 2025 report on the economic well-being of us households, the average APR on accounts carrying a balance was 22.76% as of the fourth quarter of 2025, per the Federal Reserve SG.19 consumer credit release. And the dominant emotional response to this slow compounding loss is not fear, it is tolerance. So here is the question this entire video is built around. Why does losing $500 in the stock market feel like an emergency, but paying $500 in credit card interest over 6 months barely register? If you think the answer is obvious, it is not. And if you think it is just about financial literacy, that people carrying credit card debt simply do not understand interest, you are wrong. The answer is wired into the way every human brain processes loss. And once you see it, you cannot unsee it. Let me show you what I mean. In 1979, two psychologists, Daniel Kahneman and Amos Tversky, published a paper called Prospect Theory, an analysis of decision under risk. The core finding was simple and brutal. Losses feel roughly 2 to 2.5 times more painful than equivalent gains feel good. Lose $100 and the sting is about twice as intense as the satisfaction of finding 100. This is not a character flaw. This is a measurable, repeatable feature of how the human brain evaluates outcomes. Every brain, yours, mine, everybody in the room. Now, here is where it gets interesting. Loss aversion does not activate equally across all types of losses. It activates most strongly when the loss is visible, sudden, and connected to a decision you made. You chose to put money in, you watched it shrink. You can see the exact dollar amount you are down. That is a visible wound. Credit card interest is none of those things. The interest is not sudden. It accrues daily in fractions of cents behind a screen you are not looking at. It is not connected to a single decision. It is connected to dozens of small purchases spread over months, and it is not visible. Your statement shows a balance. It shows a minimum payment. It does not show a bright red number that says you lost $412. This quarter to interest alone, there is no scar, there is no moment of impact. The money leaves so slowly that the brain does not categorize it as a loss at all. It categorizes it as a cost, like rent, like a phone bill, like something that just is. And that distinction, loss versus cost, is the entire mechanism. When you open a brokerage account and the number goes from 10,000 to 9,200, your brain screams, $800 gone, you did this. You made a choice and the choice went wrong, and here's the proof in red digits. Loss aversion fires on all cylinders. The pain is immediate, vivid, and personal. When your credit card charges you $186 in interest this month, it shows up as a line item between your grocery charges and your streaming subscriptions. Your brain files it next to the electricity bill. It does not scream. It barely whispers. That is not because the credit card loss is smaller. Over time, it is almost always larger. Let me walk you through a real scenario. Take a person carrying $10,000 in credit card debt at 22.76% APR. The current average for accounts carrying a balance per the Federal Reserve SG.19 release. This person makes minimum payments, typically calculated as 1 to 2% of the balance plus accrued interest. Under those terms, payoff stretches well beyond 20 years. The total interest paid over that period runs north of $15,000. This is all publicly available math based on standard amortization assumptions, not personal advice for anyone's specific situation. But the numbers paint a picture that is hard to argue with. Start with 10,000 interest takes its cut every month. The balance barely moves. 2 years in, this person has paid over $4,000 and the balance is still above 9,000. 5 years in, over $10,000 has been paid total, and the balance is still hovering near 8,000. The money is not leaving in a dramatic crash. It is leaving like a slow exhale, $15,000 or more in interest on a $10,000 balance, and the person carrying it does not feel afraid. Now, take the same person, same income, same life. They put $10,000 into a broad index fund. The S&P 500 has returned roughly 10% annually over the last 30 years, per historical data tracked by NYU Stern's Aswath Damodaran. In any given year, the account might drop. In 2022, the total return dropped over 18%. That year, this person would have watched their 10,000 become roughly 8,200 on screen. And every instinct in their body would have said, get out. But here is the thing. Even after that 18% drop, if they did nothing, the recovery happened. It always has, not every year, not on schedule. But over 10, 20, 30 years, the exposed money grew. Past performance does not guarantee future results, but the historical pattern is well documented. The credit card debt left on minimum payments only shrank at the pace of erosion. The investment, left alone, compounded upward, but the brain flagged only one of those as dangerous. You stood in line at the pharmacy last week. Your phone was in your left hand. You opened the banking app, not because you needed to, just to check. You saw the credit card balance. You already knew roughly what it would be. You closed the app. You did not feel fear. You did not feel anything. That is the invisible bleed doing exactly what it does. And honestly, I get it. The fear of investing is not irrational. It is asymmetrically rational. Your brain is applying a real, valid survival mechanism to the wrong category of financial event. The threat detection system is calibrated for visible, sudden, controllable dangers. A stock portfolio dropping $800 in a week triggers every alarm. A credit card silently extracting thousands of dollars over years triggers none. This is educational content, not financial advice. Everyone's income, debt situation, risk tolerance, and tax bracket create a unique picture that a general video cannot address. If any of these numbers hit close to home, a certified financial planner or a nonprofit credit counselor who knows your full situation is the right next step. Nobody posts about this part on social media. Nobody announces they just realized their credit card has taken more from them than the 2022 market drawdown ever could have. Everyone adjusts quietly. Now I want to be careful here, because everything I have said so far has been building a case that being afraid of the stock market is rational. And it is. The fear is real. The psychology is documented. Kahneman won a Nobel Prize for this work in 2002. Nobody is telling you the fear is stupid. But here is the part that should break your brain. The fear is rational, and it is still costing you more than the thing you are afraid of. That is the reversal. The insight is not that you should stop being afraid. The insight is that you are already losing money right now every month. You just cannot feel it. And the reason you cannot feel it is the same mechanism that makes the stock market feel terrifying. Loss aversion is not protecting you from loss. It is redirecting your attention away from the loss that is already happening and toward the loss that might happen. Think of it this way: a visible wound and an invisible bleed. The wound is dramatic. It is red. It demands attention. You put pressure on it, you bandage it, you monitor it. The invisible bleed has no visible entry point, no pain signal, no urgency. By the time you notice it, the damage is not a scar, it is a deficit. Every dollar sitting in credit card debt at 22.76% is bleeding at a rate that no savings account, no CD, no money market fund can match. The top high-yield savings accounts pay around 4 to 4.5% right now. Per Bankrate and FDIC data as of April 2026, the credit card charges nearly 23. That is not a comparison. That is an 18-point gap running against you every single day. Even for me, and I tend to assume the worst about these systems, this one was hard to look at. The math is not hidden. It is not behind a paywall. It is on every single credit card statement in America. But the way the brain processes, it makes it functionally invisible. Shlomo Benartzi and Richard Thaler published a paper in 1995 in the Quarterly Journal of Economics that built directly on Kahneman and Tversky's framework. They called the concept myopic loss aversion. The idea was this: how often you check your portfolio changes how much pain you feel. If you check daily, you see losses nearly half the time because short-term market returns are close to a coin flip. If you check once a year, you see losses far less often. If you check once a decade, almost never. The more frequently you look, the more loss aversion fires, and the more likely you are to pull your money out or never put it in. Credit card interest works in the opposite direction. You see the balance, you do not see the interest accumulating in real time. You see the statement once a month, and the interest is embedded in the total, indistinguishable from the spending itself. The evaluation frequency is near zero, so the pain signal is near zero. Same brain, same person, two financial events. One is checked obsessively and generates maximum fear. The other is barely monitored and generates no fear. The one generating fear is statistically likely to make you money over time. The one generating no fear is mathematically guaranteed to take it. That is not a metaphor. That is the structure. Now, let me put a human face on this. A 29-year-old dental hygienist in Charlotte making around $75,000 a year. Credit score 710. $11,000 in credit card debt accumulated over 3 years of normal life. Not reckless spending, just the ordinary drift of car repairs. A medical copay that hit at the wrong time, a move that cost more than expected. Minimum payments running about $280 a month. This person has been told by friends, by family, by the internet to start investing. They have not, when asked why, the answer is always the same. I cannot afford to lose money right now. They are already losing money. $209 a month in interest alone at 22.76% on 11,000. That is $2,508 a year gone. Not into an account, not into something that compounds for them, just gone into the issuer's revenue line. And every institution with a financial stake in that person's decision has a structural incentive to keep the minimum payment low, the interest invisible, and the fear of alternatives high. Nobody profits when you pay off the card early. The card issuer makes money every single month you carry the balance. The brokerage makes money if you invest, but the fear of investing is louder than the silence of interest. And that asymmetry is not an accident of psychology. It is a feature of the system. The dental hygienist in Charlotte made every decision that seemed reasonable at the time. The car needed brakes. The medical bill could not wait. The move was not optional. Each charge was small enough to absorb. The total was not. And now $209 a month leaves without a sound. Let me put the two paths side by side. Same person, same $75,000 a year. Path 1, the current path, carry the $11,000 in credit card debt. Make minimum payments, lose roughly $2,500 a year in interest. Over 10 years, that is north of $20,000 paid in interest alone. Assuming the balance drifts but never fully resolves, which is the statistical norm. Path 2, hypothetically, if this person redirected that same $280 a month into a broad market index after the debt was cleared, at a 7% average annual return after inflation. Over 20 years, that monthly contribution grows to around $145,000. Based on standard compound growth assumptions, $280 a month, same money, one path destroys it, the other compounds it. The gap between those two outcomes is not created by intelligence. It is not created by discipline. It is created by which loss the brain can see. The visible wound and the invisible bleed. The wound gets all the fear, the bleed gets all the money. There was a moment last month, maybe late at night. You opened the app, you saw the balance, you knew roughly what it would be. You did not do the math on how much of last month's payment went to interest. You did not calculate what that money would have been worth in 30 years. You just looked at the number, absorbed it the way you absorb the weather, and closed the app. That is not failure. That is the brain doing exactly what loss aversion tells it to do. Minimize the visible threat. Ignore the invisible one. The system was not designed to show you the bleed. The statement format was not designed to make interest feel like a loss. The minimum payment was not designed to make you angry. It was designed to make you comfortable, and comfort in this context is the most expensive feeling you can have. So here's the question I am going to leave you with. It is not a rhetorical question. It is a math question, and you can answer it tonight. Open your most recent credit card statement. Find the line that says interest charge this month, multiply it by 12. That is what the invisible bleed costs you per year. Now ask yourself, is that number more or less than the worst single year stock market loss? You are afraid of, you already know the answer. The question is whether knowing it changes what you do next.